Hey everyone, my name is Brant Phillips, in case we've never met before, and I want to welcome you to a replay of a presentation that a business partner of mine and I recently had regarding a multifamily investment opportunity in the Houston area, but there's also some good general insights about what to look for as a lender when you're looking at investing in a deal and in looking at investing with a real estate investor into a potential real estate deal. So watch the recording and I hope you enjoy it, get a lot of insights, and as well as if you are interested in this opportunity or other opportunities like this, just reach out to me. I'm going to leave my email in this presentation, so just contact me via email to either request more information on this deal or just general information about how you too can be a private and passive lender in one of our deals. All right, take care, and I hope you enjoy the replay. Record. I forgot to do that. I do that quite frequently. And we're going to start over. Take two.
Okay.
All right, everybody. So thanks for joining us. Appreciate you coming on. We are talking today about how to become a passive investor, passive lender in a commercial or multifamily deal. Today it's a commercial type deal. And, you know, one of the ways that I was talking about, one of the greatest ways to actually learn something is just to go do it. And so one of the also greatest ways to learn as become an investor is to talk to real life investors with real life deals. So we've got a deal that we're working on now that Steve has under contract here in the Houston area. So he's going to, in just a little bit, give you guys an overview on what this deal is, what the opportunity is, and show you some of the things that he's doing for his due diligence. And he's also going to give you some just general training about what or about how to make yourself a better educated and equipped investor. So when you begin analyzing deals, whether it be commercial or a multifamily deal or a residential deal, whatever it may be, that you're better equipped into how to analyze the deal and how to understand the numbers, how to speak and interview with the lenders who are putting the deals together. Like, who are your leads in these deals, and are they doing all the things that I know that Steve does? So thanks everybody for hopping on, and I'm going to turn over to Steve to introduce himself, tell you guys a little bit about himself and his background, and just some of his credibility, and also that we'll get into this deal because we are actually seeking investors on this deal that we're going to get into here in a little bit.
All right, great. Well, thanks for having me, Brant, and it's a pleasure to be here with all of the fine folks who are tuned in. And as Brant has shared with you, I am an active investor. I'm an author. I've written about 15 books now, 10 of which are on real estate and various topics. I've got probably about 270 million in transactions under my belt now. My most recent deal is a 109 unit apartment complex over on the east side of Houston. We purchased that in two phases, closed on the last phase in June of 2015. And we did roughly just under 500,000 in total rehab. It's about 470,000, I think, is the most recent number in rehab and renovation. This was an undervalued asset that was not taking full advantage of market rents on the east side of town, and we were able to go in, renovate, and push and boost the rents significantly. And we now have the property positioned for exit, and we are in the process of selling that for just under $5 million. Be a nice capital gain for all of my investors who have partnered with me on this deal. And again, this is in a little less than a year. By the time we get it under contract and the deal closed, would be right at about a year is our current expectation. So we are actively marketing the property, and it's been a very successful venture for us thus far. I've been investing in multifamily properties here in the Houston area since the 90s. We relocated to Michigan for a while. I got into some other real estate activities just because of the dynamics of the market. We did a lot of single family construction and several development projects. We did some condominium projects some duplexes, smaller multifamily projects in that area, and then relocated back to Houston in the summer of 2013. And since then, I've been involved in a number of multifamily projects. The most recent one that I currently have under contract, and as of yesterday, I met with the engineers, and we are prepared to move forward with this project. Total deal value on this will be approximately $4 million, and we'll be looking for about $1.5 million, roughly 1.5 from our investor partners. This is multifamily in a sense, but it is multifamily of a different sort in that it is comprised of an RV park, which is intended more for long-term use as opposed to weekend travelers, in part because of the location. So it's an exciting opportunity. I got into this particular project for a couple of reasons, one of which is my family and I are avid RVers, campers. Our boys grew up in a scouting program. My two older boys are both Eagle Scouts, so we've done the tent camping, and then we transitioned into a smaller travel trailer and then a larger travel trailer, and now we have a real nice motor home that we like to travel around in. So I've been in and out of RV parks for many, many years, and I don't want you to confuse RV park with a mobile home park, because this is not a mobile home park. RV parks are much different. One of the things that I really like about this project, well, there are a couple of things, and Brant was with me when I was trying to put the last apartment deal together over on the east side of town in Baytown, and that was a smaller deal, 56 units, and we ended up at the end of the day getting outbid by another buyer who could close quicker than we could. He was an all-cash buyer and could close in 30 to 45 days. I was unable to do that, so I got frustrated because these deals take a lot of time and energy and resources on my part. Number one, to locate them, but number two, to actually go through the inspection process and the due diligence process to be able to put these things together. So I was extremely frustrated at not being able to take advantage of that particular opportunity. Another one of my contacts, a broker here in Houston, I talked to him about the RV concept. He just happened to be aware of this 10-acre parcel of land on the west side of town that was on the market back in 2011. The seller was unsuccessful in selling a property, so it's currently an off-market deal. I found that to be appealing because I wasn't competing against other buyers, and especially considering the fact that I just gotten beat out on that 56 unit deal in the Baytown area. So I wasn't competing against other buyers. I was able to take my time and structure this deal the way I saw fit. Brant, I don't know if you want to interject.
The only thing that I want to interject is for those of you who have read my book or follow me at all, on the residential side, we tie things back when we're flipping a house or doing a deal to the 7 fundamentals, which begin with mindset, start with creating deal flow, having deals come to you, ideally, rather than having to go out and search for deals. Then we get into how to analyze a deal, how to estimate repairs, manage the rehab, finance the deal, manage the rehab, and then create income, generate income from that. So a couple of things, I'm going to take a step back, is like what is this looking through your lens as a passive investor? So what is your mindset going into a deal? So I just wanted to show you a couple of things, is that whenever you are analyzing a deal with an investor, there's the Warren Buffett thing about, first show me how you're going to return my money before we talk about the return on my money. And so as an investor, you want to make sure that you're working with credible people who are experienced. So I don't know how many other investors out there have multiple books published like you do over the last 10, 15 years. So that kind of goes into the mindset of, I would think as an active investor, is like you're working with credible, established people who not only has a track record, but written multiple books about the subject that we're discussing now. And the second thing, so just kind of following the outline for you guys, is like, so deal flow, like how do you generate deal flow as an investor, and then how do we do this as a lender, and how do we do this as investors? So one thing that I know that I found to be very similar, I'll push back a little bit, is that you found this deal a similar way that residential investors find deals, is networking, your relationships. This one came from a broker from another deal, and then you began to get into the due diligence phase. So tell everyone, like, after that kind of initial phone call, like, hey, I may have a deal, but where did it go from there? Because analyzing a non-standard commercial deal is much different than just a single family home, and it's not a skill set that everybody has.
And you're absolutely correct, Brant. Analyzing a residential deal is much different than analyzing a commercial opportunity. My background in finance and banking, I have an MBA from Rice University. I graduated there with focus in finance and business marketing. And I worked in the M&A, mergers and acquisition department of a large Houston bank for several years. So it was that time that gave me the opportunity to develop my analysis skills and to be able to understand and appreciate cash flow. And really what all of these commercial properties have in common is what we refer to as NOI, or net operating income. So values for just about any type of commercial property is derived from the net operating income, and the appropriate cap rate is applied. It's referred to as a cap rate. It's also known as a capitalization rate, but cap rate obviously being short for that. And to capitalize a value, what you're doing is you're taking an income stream and you're finding the present value of that income stream. So it's much different than a residential deal where you're looking at primarily comps in the neighborhood. So for example, if you find a small deal on a street that's selling for $100,000, but the house across the street is selling for $150,000, and you have similar square footage and similar lot size, then you can say to yourself, okay, what changes can I make to this property in order to bring it up to the value of the property across the street? Because I'd like to buy it for $100,000 and sell it $150,000. And what's it going to cost me to do that? What does the rehab component look like to do that? So really, you're relying on comparable sales for the houses in the neighborhood. So it's a comparable sales approach, and that's one of the methods of establishing value, appraising a property. The method that we rely on primarily, and I've written extensively about this in a couple of my books. One is the book about it's really a primer, how to buy and sell apartment buildings. The other book is The Complete Guide to Real Estate Finance, and I go into quite a bit of depth in going through the actual step-by-step calculations to help readers understand the process. But essentially, Brant, what we're doing is just looking at the net operating income from the property, and then we're taking an appropriate cap rate depending on the location, the size of the property, the age of the property. It may be a 7.5 cap, it may be an 8, it may be a 9, it may be a 10. Mm-hmm. There are several things to take into consideration. So that's kind of the difference in the process and what I'm looking for. And like in a single family rehab, you're looking for what's my upside opportunity with this. And I'm doing the exact same thing. And I wrote extensively about it in my first apartment book, what I refer to as the value play strategy. So it basically is fix and flip on a grand scale. Mm-hmm. And it's a much more efficient process when you're flipping a multifamily property. Just think about from a transaction oriented, I can buy one 100-unit apartment building and I have one transaction involved, and actually two, because I buy and then I sell. If you buy 100 single family houses and you try to do that within a year, you have 200 transactions. And think about the machine that you have to have in place in order to do that, to accomplish that. You have to have a lot of team members in place. That's 2 closings It's actually 4 closings a week, because if you're buying 2 properties and you're selling 2 properties, you can spend a lot of time in your closings. Contrast that to a 100-unit apartment building. I'm buying once. I get my trades out, and they stay focused on the one asset. And my management team focuses on increasing the rents to the market rates. And then when the appropriate time comes, we position a property for sale, take the gain, and move on to the next deal.
Mm-hmm. And so on this particular deal, we can talk about and show some of the things you have going on here. But the big thing that really caught my eye and was really attractive to me was that the amount of money that people are paying to park an RV on a piece of concrete and get some water and a plug per month. It blew my mind. It's as much as people pay for apartments and even houses. I've got some rental properties that the people don't pay as much as what these people are paying to park their RV on a piece of concrete.
Yeah, it's totally amazing. Yeah. It's totally incredible. And so that's one of the key advantages to this particular type of multifamily property, if you will. It's not a true multifamily, but I consider it multifamily. Because you have multiple residents living in one location. So as Brant just shared, in my current apartment deal, 109 units, when we bought that, rents for 1 bedrooms were going for around $500 to $525. Well, we've been able to successfully push those all the way up to $725, $695 for some of the 1 bedrooms, $725 for some of the other ones. And I really get excited about being able to charge $695 to $725 for a 1 bedroom on the east side of town. That's exciting for me because we've made a lot of progress with this particular property. But think about being able to charge $650 or $695 or $750 for, as Brant shared, a piece of concrete. So you're giving RVers the opportunity to pull in with their travel trailers or their motorhomes and park on a slab of concrete for around $600 to $700 a month. From an operator's perspective, what it costs me to operate the apartment buildings, every time somebody moves out, we have a make ready. So there's at the bare minimum, there's going to be carpet that needs to be cleaned, very possibly ripped out, replace the flooring. All the appliances need to be cleaned. It may need to be painted. So the cost of turning that unit could be several $100s. It could actually be several $1,000s depending on the condition of the unit. And not to mention the cost of new construction for the asset itself. Compared to an RV park, all I'm doing is I'm putting in roads, the underground utilities, and we're pouring 45-foot concrete slabs for people to park their travel trailers on. And each site will have water, sewer, and power, both 30 amp and 50 amp service because of the different needs of different trailers and motorhomes. So for the privilege of parking, they're paying $600 to $700 a month. What they get for that is water and sewer. And when you have long-term residents, believe it or not, because each property has its own separate meter, they are actually paying for their own electricity also. That way you don't have people who are leaving for the day. They leave their AC running because it's not on their dime. They leave for the day, and their air conditioning runs all day long, so it's nice and cool when they get home in the evening. This way, they're paying for it. It's on their dime. So if they want to leave their AC running, that's fine by me because I'm not paying for it. So the operating cost for an RV park like this are much, much lower. The yields on this particular deal, the cap rates, the yields, this property has tremendous potential in it. I really, really am excited about this deal.
Can you tell them some of the other things that are planned for the project in addition to the RV parking?
Well, we have right now, as of yesterday, 85 pad sites for RVs, travel trailers, motorhomes. And just so that you understand this type of market, this is different than an RV park that you might find off of I-10 close to a major attraction. Could be any number of things. Those types of parks are destination parks where people are coming to spend 2 or 3 days. They might want to get out of town for the weekend. They're coming to spend the weekend, a couple of days. They may have a handful of people who are there on a more permanent basis. This park's intended use will be for those who are in town and more of a permanent 6 month to 1 year, 2 years, 3 years type of basis, in part because of the location, but also that will help the property to achieve a higher level of profitability and income because of the stability of the tenants who are there. 85 sites is what I would call probably a medium-sized park. I've been in parks, in fact, we took our motorhome down to Padre Island at Christmas time, and there's a large state park there that has like 650 sites, so it's huge. This park is small in comparison, and I don't think it will take much at all to fill it up. The park that you see on the screen there is one that's located just a couple of miles from our site. They have, I believe it's 197 spaces. They're almost full. The people who are in there are paying $671 to $774 a month for rent. And those people are people who are in Houston to work. It gives them an alternative to the traditional apartments. There are pros and cons to all types of living. So whether you live in an apartment, there are pros and cons. If you live in a single family house, if you live in an RV park, there are differences among all of those. What people like, and including myself, what we like about the RV motorhome aspect is that it's our own space. So unlike an apartment where you go in and you're renting what's available, here with a travel trailer or motorhome, it's your space. You're free to do with it what you want. As an owner-operator, that's an advantage to me, because if their trailer or motorhome breaks down, I don't really care because I'm not the one who's responsible for the cost of that. So the site, just a couple of miles from our proposed site, as it states here, they're full. They're getting strong rents. I know there's room in the marketplace for a competitor. We would probably begin marketing the property at about $595 until we hit roughly the 50% threshold. We'll see how we're doing with respect to filling up, and then begin to push rents or monthly rates up higher than that. So that's one component, Brant, of the revenue stream for this property. The other thing that we have in mind, well, actually a couple of other pieces, but there's currently a large equestrian center. And if you scroll back up, you can see that from the aerial right there. So that building is 228 by 36. I don't know off the top how many square feet that is. It's a bunch. 228 by 36. Brant's going to figure it out here for us. I should know that, but I don't. So, okay, 8,200 square feet. And then we also have the ability possibly to put in a second level if we decide to do that. We're still undecided at this point. But currently there are about 40 stables in that building, and those will be converted to rental units for mini storage. So more than likely, out of the 85 RVers that we have in a park, a good number of them will want to rent these spaces from us. And then also, because we're in a highly residential area, there will be people from the surrounding area, if we're not able to fill up with our RV tenants, who will be interested in renting also.
Yeah, very close proximity to a high traffic area, Houston area.
Yes, it's just north of Clay Road and west of Highway 6, and it's a solid residential area. The back portion of the land will be used for RV and boat storage. So people who want to store their travel trailers or their boats, I think we'll have capacity for around 100 spaces. I don't know exactly what that number is going to be just yet. So far we've got three components. We have the mini storage, our primary, which is our RV, 85 spaces, and then we have revenue that will be derived from RV and boat storage. There are a couple of parks just across the street and close by that provide for both mini storage and boat and RV storage, and I've called on those, and they're both full. and I know what they're getting for their market rents, we should be able to compete with them without any problem at all. And then the fourth component here is just a little bit of revenue from laundry facilities, vending revenue. So that won't add a whole lot to the value of the deal, but it's a fourth component of the revenue here. So that's what we have planned, and we're moving forward with the project as of yesterday.
Yeah. So I want to open it up too. If any of you have questions about this project or just in general, as becoming a passive investor or lender, go ahead and submit those now, and we can open them up. Do you want to get further into numbers on the deal on a spreadsheet?
Well, we can scroll down, and I'll hit the highlights while people are compiling their questions. So here is the site plan, and I don't expect that to change too much. So you can see along the top of the screen will be the entrance. That's French Road. And then the back of the property, it's a 10-acre parcel. The back of the property backs up to a residential neighborhood. This project, by the way, will not be on city water and sewer. There are pros and cons, but the advantage, it'll cost us a little bit more going into it, but we'll be on well and septic. So that means our water bill each month will essentially be zero, because we're not paying, roughly $50 a month or so for water and sewer per unit. So that's about $5,000 a month. Mm-hmm. And you'll still have some costs with chemicals and treatment and things like that. But once the system is in place, it's pretty much runs itself. Mm-hmm. We'll have a on-site well, so it will be self-sufficient from that perspective. Yeah. And then, of course, we'll have power brought in and power run to each of the pad sites. And as I mentioned previously, they will all be individually metered so that the residents there will be responsible for their own power bill. Mm-hmm. If you want to scroll down just a little bit, I can hit some of the highlights, and I'll need my glasses for this.
You have to tell me when.
That's good. So I have these deemed as phase 1, 2, 3, and 4. Call them phases, call them whatever you want. But really that's the breakout in the revenue components. So up at the top, boat and RV storage, number of spaces, it will be approximately 100, monthly rent, 85. And what you see here, I've put together a total of, I think I have 8 of these schedules, and I'm not going to take time to go through them all line by line. I'll just kind of hit the highlights. But just so that you understand, this is the way that I like to look at deals. I do what's called a stress test. This will be helpful to the lender also. So 25% occupancy at $595, because I want to see what the cash flow is going to look like. So you can see on the screen annual revenues of $194,625, and then that kind of feeds into operating expenses. I've estimated about $200,000 per year, and then the cash flow and what that looks like going forward. So you can see if I were to try to sell the property at this juncture at only 25% occupancy, my estimated gain on sale, I would have a huge loss. And so it would make sense to do that. But again, I want to know more from a cash flow perspective, how much negative. You can see the net cash flow number of negative $217,000. That's not a good number. So we're going to work very hard to ensure that we're able to perform better than that. So here's the next schedule. This is at 50%. And you can see, okay, that's not quite as bad. We're losing $23,000 a year. If we were to try to sell the property, we wouldn't make anything. 53% occupancy required for break even. So at this point, my cash flow, my net cash flow, I'm essentially breaking even. And that's what I want to know. Okay, to break even on this deal, to where I can service the debt, is I need about 53% occupancy at these rates. And the 595, I believe, is a conservative number. That's how I want to start out. And here, we're starting to get close to a break even on the value and the corresponding value in the sale. So this next one is 58.5% for what's referred to as a DSCR 1.2. That's debt service coverage ratio, and that's an important number to the lender. I don't care so much about that number, but the lender cares. And with some lenders, that number might be 1.1, it might be 1.15, it might be 1.2, it might be 1.3. It just depends on the lender. The lender that I'm working with on this project, their number is 1.2, so I've included this in their benefit. So what's important to the lender is they can see, okay, this project needs to be at 58.5% occupancy at these rates to have this debt service coverage ratio of 1.2. Again, that's an important number to them. They'll want to know what that is because that says I don't have to be full at the property in order to service their debt. They want to know that we can pay the bank back and have a little bit left over.
And then just to touch on that too is, when he's talking about lenders, the bank's going to come in as the first lien, as most likely the majority of the capital for the project will come from the bank. And
correct. And I did fail to point out in this lower left-hand corner, financing assumptions. You can see total project cost of just under $4 million. The loan to value is 75%, so the loan amount is about $3 million. That number is by no means a hard and fast number at this point. Estimating between about 4 and 4.2. It could be a little bit lower. It could be a little bit higher. But generally speaking, we're at about $3 million on the loan amount. And then if you look at the bottom there where the annual payment using these assumptions, a 25-year payback, 5% rate, 265, that's the number that is used to calculate that and the net operating income. And so that's where that ratio comes from. I didn't mean to interrupt you, Brant.
No, it's okay. I wanted to make that clarification, people, that there's a bank involved, and a bank that you've done a lot of investment deals with. And I know one thing with newbie investors, the same rule applies to this, especially with new passive investors and lenders, is like sometimes with hard money lenders, for example, and sometimes institutional lenders, they're a part of your team. And so I've had, in the beginning, it was year one, I was starting to do a lot of real estate, and one of my lenders told me no on a deal. He's like, no, Brant, I'm not going to loan to you on this deal, because he had some insight and some experiences. He saw some things that I didn't see. So after, I got my ego restored, I'm like, okay, let me look at what's really going on here. Like, I appreciated him saying no to me, and I learned a lot from that. Mm-hmm. So it's the same thing whenever, as a passive investor, when you're working on a big deal like this, on a commercial deal, when there is bank financing involved with a local, investment banker, that's something else that you can just add to the mix of, like, okay, as you're doing your due diligence, it strengthens the deal, in my opinion, because they feel good about this deal and these numbers that we're presenting right now.
Exactly. That's an excellent point, and I assure you that they would not write a check for this project for $3 million if they weren't confident and didn't feel comfortable with me personally as an individual. First and foremost, that's what they're going to look at, is who is the sponsor on this deal, and what's his background, what's his track record, and have we done business with him before? Do we like this project? So there are a lot of things that go into the decision-making process. Another important part for the lender, identifying the lender, is not all lenders like to loan on RV parks. Not all lenders like to loan on apartment buildings. So you have to find what they're comfortable with and identify that, and then use that to your advantage. So I happen to work with a lender here in town. They're a local lender, and they happen to like apartments, and they also happen to like RV parks. And in fact, they're financing a deal not for me, but for another developer in Galveston. There's a new park going in down in Galveston right now, and they're financing that deal. So they're already comfortable. And so those are two major hurdles. You have to clear that threshold in order to even be able to get your foot in the door.
Yeah, and they probably like them a lot more when there's other properties in decent proximity that are 95 to 98%
Sure,
occupied.
I'm sure that helps their
Doesn't hurt
confidence
anything.
level.
Yeah.
Absolutely.
Yeah. So do you want to go to some higher occupancy rates?
Sure. And, again, we can just kind of skim through this, but at 75%, you can see we're starting to get into the green there. For investors at 75%, the annual dividend payout to shareholders is 6.86. Of course, that number is just an estimate. It's a preliminary number. So you're not making a whole lot of money at 6.86%, but I can assure you that that's more than any bank is paying. But that's not why we're in this. I guarantee you I'm not in this for 6%. I'm looking for a lot more. So here at 95% occupancy, which I think is a reasonable number and a conservative assumption, we won't get there overnight, but within 6 months, I expect to be at 95% or close to it.
After 6 months after
construction, correct.
Construction
after construction is completed.
Marketing plan is in place.
We'll begin the marketing initiatives well before and begin pre-leasing well before the construction has been completed. I can assure you of that. So here you can see I have these numbers bolded. So annual dividend payout to shareholders at 13%. That's a little bit more respectable. And then what I've incorporated into the analysis here at the bottom, you see the valuation matrix. So if we were to turn around and sell the property and using these various cap rates, and I've bolded 7 and 7.5% because I think that's the most reasonable number where this deal would trade at if we were to try and position for exit. So the corresponding value is 7.7 million at 7 cap and 7.1 million at a 7.5. And the value created, the gain on sale, is 3.7 and 3.2. So if you go right back up to the line just below the dividend payout of 13%, and look at the return on equity from the sale at 48% and 28%, and now those numbers are starting to look pretty attractive. So let's go down one more, and this one I've called the most likely scenario. So here's my target. This is where I expect us to be. I've used 595 in the other spreadsheets just to be conservative. This one I've used 650 because that's my target. I want to be at 650 or above. So here we're at 15.2% annual dividend payout. Those are paid quarterly, by the way. If we were to sell the property, you can see the estimated gain on sale at 4.4 and 3.9, and the returns to shareholders at almost 80% and 56%. So those are pretty good numbers. I don't know about you, but for me, I'll take a 50 or an 80% return all day long. And then here we're at 695, and keep in mind that the other property just down the street, I think I said it was leasing from 670 to 770. I think those are the numbers that I had. So even at 695, I believe that this is a little bit conservative. I think there's room, especially for a brand new park, in offering the features and amenities that we'll have here. But here you can see that the numbers, the dividend payout is almost 17%. That's very, very respectable. If we were to sell the property, it's almost double your money at 104% and 80%. And these, I won't go through all of this. This is just a cost breakdown of some of the construction costs that I've included, really more for the benefit of the lender. So we'll scroll back up real quick and just hit the highlights for the investors site plan.
And then today was really just an introduction. Wanted to give you a little bit of an overview and meet Steve and kind of show you what due diligence he does, he puts together on his deals, but also just to show you an overview of this project if you're interested in investing. To contact us, and so we can go into more of the in-depth numbers, like he just mentioned. What are the construction costs that we have put together? and just dig more deeper into the pro formas on what does this really look like, what are the hard costs, what are some of the construction hurdles that are going to have to be overcome to get this deal, you know, at a profitable state.
That's exactly right. For those of you who may be considering investing in this opportunity and who haven't invested or partnered with me before, I typically offer two different programs, and I've got them highlighted here. But the top one is preferred shares, guaranteed rate of return. So that 6% accrual rate at time of deposit. If you write a check today or tomorrow, whenever, for $100,000, I'll deposit those funds, and we'll pay 6% on those funds at an accrued rate. So the 6% accrues from the time of deposit. The funds are not actually paid out until the property begins to cash flow. 12% when construction is complete. Dividends paid quarterly after cash flow positive. So no equity participation at time of sale. So basically when we sell or refinance, you get your money back and you've been able to enjoy the benefit of either 6% and 12% throughout the life of the project. Non-preferred shares, 4% accrual at time of deposit. Dividends paid quarterly after cash flow positive. Dividends distributed based on a percentage of ownership. And so what that means to you is that the yields, the dividend payments that I showed on the spreadsheets, that would be applied equally, but that would be the approximate percentage based on your investment. So obviously the actual dollar amount is going to be different for everybody. And then equity participation at the time of sale or refinance. So we sell the property or we refinance it, pull some cash out, and then you are a true partner in this deal, and you will be able to participate at the rates or approximate rates shown further down in the presentation on the spreadsheets. So if we're to do exceptionally well, I mean, there's a possibility of earning an 80 or 100% return in a fairly short order. This project, I don't remember if I have that in here.
And for any of those of you who are interested in more details, we can email you the presentation today and with all the spreadsheets and everything else.
Right, and be happy to do that. So yeah, expected project life 2 to 5 years on this. And I like to leave myself some room because it really depends on what's going on with the markets from a global, a macro, the treasury yields, a 10-year. All of those things are to be factored into consideration. It has to do with availability of capital, what the markets are doing, a number of things that we take into consideration. Also, certainly, if we happen to get an offer that we can't refuse and it makes sense to pull our money out and take the gain on sale and roll it into the next opportunity, I will do that all day long. I'm much more of a buy and sell type of individual than I am a buy and hold. I like to trade. I like to create value and move on to the next project. And I don't expect that this one will be that much different. So did you get any questions?
I don't think that we did. Oh, wait. Yes, we did. Sorry about that. Okay, estimated date of completion, you just answer that, 2 to 5 years. Most likely, it's probably somewhere in the middle.
Well, do they mean when they say date of completion, do they mean with construction or do they mean?
That's a great question.
Or closing?
Okay, so we'll ask, I guess answer both.
Yeah. So right now we're beginning, as of today, we're beginning to accept investor funds for this project. My expectation is that we will close in the month of May. That's my hope. It could get pushed a little bit further. I wouldn't expect it to go past June just because of my contractual obligations to the seller. And then we're probably looking at about 6 months to completion. Right now, we're working on the final designs, getting all the engineering work done, the scope of the project, the bids in. We'll have our the project fully approved before we close. That is the goal. I think just to protect our own interest, I want to make sure that we're able to close on this and have all of our approvals in place. And after visiting with the engineer, that should put us about the end of April to have our approvals, and then we'll prepare to wrap up and close a few short weeks after that. So construction, if we begin in June, that would take us through the end of the year, and then we're into January 2017 approximately to when we begin leasing spaces out as quickly thereafter as we can. But as I've already indicated, we'll use that time, the 6 months, to begin pre-leasing. I've already got some things lined up for some very solid marketing initiatives that we'll put into play and begin pre-leasing so that when we open the doors, we have revenue from day one. That's the hope.
Yeah, that's the plan.
That's the plan.
Let's see here. Another question, same question about target date to complete with construction. What are share prices? I think that's on the screen right here.
Yeah, $1 a share.
And then that was just Rolf coming back on to confirm it was about construction.
Okay.
Well, I think that's all the questions, and we're within our target time frame. So anyone watching this, and I'll be posting this on the replay as well. I will send you guys an email, everyone who's in attendance right now, on the best way to contact me if you're interested in this. And the simplest thing to do is just reply to that email, or just email me at brant@investhomepro.com, and I'll send this to each and every one of you so you can get in touch with me, and I'll connect you with Steve and whatever other questions that you may have, because you should have questions if you're.
And I don't think this is in a slide, but generally minimum participation is 50,000.
Right, that's another great question.
Yeah, I'm sure somebody's thinking, okay, what am I going to have to pony up to be able to participate? But generally 50,000. I will consider less, but I like to see a level of 50,000, and that way we keep the number of investor partners, limited to where I'm not working with like 200 people who have put in, a couple thousand a piece or whatever. Yeah. So, anyways, I think that's all I have.
I think that's it.
Well, thanks for the opportunity.
Thank you. Thanks everyone for watching, and hope to hear from you if you have interest. Thank you.
All right.